good afternoon to all our members and associates, our board members, chapter heads from different SADC nations, and our colleagues from Citadel. I am Shiphra Chisha, the President and Vice Chair of the African Women in Business, an organization founded in 2019 to create wealth through investments for women in business in Africa and the region and beyond. It gives me a great pleasure to welcome you this afternoon to talk money matters. Over the past 3 years, we have been talking about creating wealth for women in business. Having recently formed the public company, African Women in Business Investment, we felt it was important to talk to our members and also our associates about wealth preservation. Women are known to be more preservative in wealth management. However, we need to understand the strategies that can ensure that our assets not only grow over time, but also provide a legacy for our families by creating smart personal investment strategies. We are grateful to Citadel for hosting us this afternoon to talk money matters and personal finance, a team I have known for years and a company that has been in existence for 28 years, that has over the years brought together some of the best financial brains in the business. They always assure me that my investment temperament will be matched with that of my advisor. We look forward to share their wealth and pearls of wisdom with you. We will start the session by playing a video that will give a brief overview of African women in business and African women in business investment. Enjoy the video. That is wonderful. We invite you to visit our website and tap into opportunities available to all women as they were showcased on the video. Our AWIB shares are available for less than 100 rands with a minimum subscription of 1,000 being 10 AWIB shares. That is less than $100 for my colleagues from across Africa. Shares are freely tradable as we are a publicly unlisted company in the secondary market presenting, as we've said, we're presenting extraordinary opportunities to ordinary women. And allow me to please welcome my chairperson, who I've seen just came in, Ms. Priska Soka. I've just seen her now. Now I'd like to hand you over to Karen Rennie. Karen is responsible for new business initiatives. She joined Citadel in August 1998, and her role evolved over the years to new business. She was instrumental in Citadel's strategy to encourage and empower women with their financial independence. And after 18 years, she joined Mergers and Acquisitions business, Deal Leaders Africa. After 2.5 years with Deal Leaders Africa, her passion for wealth management industry saw her returning to Citadel in 2019. She recently completed a coaching course from the Institution of Consciousness Living. I think she will keep us conscious this afternoon. She has 2 beautiful daughters, aged 13 and 11. She says when she's not at work, she enjoys gardening, cooking, and live music, with Knysna in South Africa being her destination of choice when she needs to unwind and switch off. Karen will take you over and host as a host this afternoon for the rest of the session today. Over to you, Karen, and thank you very much.
Thank you, Shiphra, and a very good afternoon and a warm welcome to all of you from myself and my team here at Citadel. The biggest thank you to all of you for allowing us this time with you. It sincerely is a privilege to be in your company. In my very short 3 minutes, I just wanted to briefly introduce Citadel and share a little bit of our story with you, and also why we're so excited to be here this afternoon with you. And that will provide context to this afternoon's event and also highlight what we would love for you to take from our time together. So I'm going to jump right in and just talk to you briefly about who we are at Citadel. And I often say to clients, I think the best way to think of us is to imagine us as your personal chief financial officer. So as you all may have a CFO in your business, and you go to that person that you trust them implicitly with all your business financial affairs, so we show up as that person in your life with you and your family. We start out by building a long-term strategic financial plan for you, and then we answer all those difficult questions like, will I have enough, or how much is enough? Will my family be okay if I'm not around? Is my will in place? Are my fiduciary matters all up to date? Am I well structured? Is my money in the right place? And. You know, we absolutely get that all of you have worked exceptionally hard to where you have reached today in your careers and in your business. But what we often find when dealing with people is that what is missing is a proper long-term strategic plan to protect and grow your hard-earned money. So that's really what we do at Citadel. And we'd love to, in the weeks to follow, meet you for a virtual coffee or a face-to-face meeting to start building your personal financial roadmap. And if you are in a position where you've either accumulated or are busy accumulating sort of between 5 and 10 million, now is a really good time for us to start talking with you. But really, why are we so excited to be here this afternoon? And as Shiphra mentioned, we initiated a strategy into the female market a couple of years ago because we noticed as a business that we were onboarding, most of our clients we were onboarding were men, but yet we knew there were lots of successful women in their own right, and yet we weren't onboarding them as clients. And we started doing a lot of research and talking to the few women in our network, and we learned a lot. And very briefly, you know, what we realized is a lot of women feel patronized or vulnerable when it comes to money matters. And maybe it's because we haven't necessarily been socialized around the conversation. We also find a lot of women feel it isn't their role. You know, it's their partner's role or their husband or their spouse. Or it just never seems to make the list of priorities. There's just too much on the go with work and family and business and the like. And maybe you also will admit that you haven't paid enough attention to your own personal financial well-being. Just a very quick story from my side. You know, when I left home to get married, I'll never forget my mom giving me her words of wisdom. And she said to me, my darling, if I ever can give you the best advice, it is to have a secret bank account. And looking back, I think it's quite scary to think that that was the sum of her financial plan. And, you know, sadly, my mom's been very unhappily married for many, many years because she never had the financial means to make decisions that were in her best interest. And I promised myself I would never get to that point. And I think all of us have some story around money. So today is really about empowering you to take, to make consistently good decisions around your personal finances. So that, you know, with the outcome being that you're going to reach personal financial freedom and you're going to have peace of mind. So Kerry King, who's a senior advisory partner in our business, is going to talk to you about a framework that we have developed over the years to help you make better decisions around your money, and importantly, to become aware of your emotions around money. It's so important to be aware of that. And then Yolanda Nordia, who's an investment strategist and portfolio manager in our business, is going to make sense of the local and global economy and identify and share with you where we see current investment opportunities for you. Then just really lastly, from Citadel side, Shiphra, you mentioned one or two things, but it's important to share this to give you comfort and confidence who we are as a business. We've been around for nearly 29 years. We manage around 70 billion rands worth of other clients' money, and that's about 4,000 families that we look after. And I share that just to give you a sense of, you know, that we've got proper traction in the marketplace. But the number we really are most proud of in our business is the fact that we retain 99% of our clients. So it really is until death do us part. And I think what truly makes Citadel the magical place that it is our people. So the likes of Kerry and Yolanda are exceptionally passionate about caring for the families that we look after. So we're going to jump right in. I'm going to hand over to Kerry. You're very welcome to post some questions in the chat box below. As we go along, we'll answer questions right at the end. And if we do run over, we do understand that at 3 o'clock, if some of you do need to leave, but if you can stay on and we can take some questions at the end, it'll be fantastic. We are now a small group, so we'll probably be able to have a great conversation together. So thank you again, and I'm going to hand over to Kerry.
Thank you very much, Karen, and welcome everybody. It's lovely to be here with you this Wednesday afternoon. I'm not sure I quite get used to this presenting to everybody out there from my screen, from our house in Saxonwold, I have to say, in Joburg. Anyway, well, you've heard a little bit about our business. Let me just tell you where my passion lies, and it falls right into your scope of what you do, and that is women and entrepreneurs. So over the last 20 years of being in this business, that's where I have spent majority of my time focusing, because actually everybody deserves for their hard-earned wealth to make sure that they become financially independent, and we all can. So I've got a quick story to tell you. At the moment, I've got a 6th-year medical student who's living with me. Her parents live in Cape Town, and being 6th year, as you know, is quite tricky. So she's coming to the end of the year. She's got her last block left. But it's been quite interesting because there have been 3 or 4 financial institutions and banks that have approached the medical school to speak to these students. So I've been very interested to find out about what they are teaching them and what they're saying. And the biggest comment that I got from her was that they're using scare tactics. They're using all these jargon words. She said, I have no idea what they're talking about. So I said, it's terrible. She said, can you please help me? Anyway, so what I did is that I sat her down on Saturday last week, her and a friend, and I said, okay, let's have a look. So this very framework that I'm going to take you through this afternoon is the very framework that I spoke to her about. So I hope you can enjoy and also not find it daunting. And please stop me if you want to ask any questions. Oh, sorry, Karen said we'll ask questions at the end. But I mean, I really hope that I can keep it simple so that it isn't a daunting framework that you can actually understand quite easily. Okay. Creating your own financial destiny. I have to say this is completely critical. We all are responsible for our own financial wealth or well-being. Sorry, just trying to get to change. So when we looked at our framework, we start with these 3 blocks. which is wealth building, lifestyle, and protecting wealth. Now, each of them relates to very different aspects of the wealth creation that we have. So the wealth building is obviously, as you know, would be where you earn your wealth. Now, I must tell you that it is absolutely your responsibility, so you make yourself rich. We'll talk about the lifestyle assets, those houses and cars that we all love, and then protecting. How do we protect the wealth that we are saving to make sure we get financially independent? So another way of talking about how you earn your wealth is obviously your business. So lots of you are entrepreneurs and earning your own income. So the biggest, sorry, let me just take one slide further. The biggest aspect about your business operation is that you need to be concentrated. So don't have 3 or 4 different businesses, because it's very difficult to focus on one individual business, to focus on 4 different businesses. You know, when you'd rather have intense focus and understand that business and become a specialist in that business. It also means that you can afford to take a little bit of gearing. So illiquidity is fine, and to gear it and to take some borrowings to grow that business is also okay. And also, so the biggest thing is, remember that you are responsible for creating your own wealth. So you can't blame the lotto for not coming in on your numbers. It's all about you. Then what happens is that as you start building your business, as the wealth starts coming in, you then start investing in the second block, is what we call lifestyle assets. Lifestyle assets are houses, cars, toys, or we could also call them, could be an aeroplane. The trick about lifestyle assets is that you can't, if you've got 5 different holiday homes, how on earth do you have enough holidays to go to 5 different holiday homes? I would love that task, actually, to try and fit that all in. But and the other thing about holiday homes and houses or toys is that they consume your cash flow. At the end of the day, they have to be maintained. You know, they've got to be repainted. Things go wrong, and that actually becomes a drain on your cash flow. So too overweight in lifestyle assets is a drain on your cash flow. So be careful here. And then the other thing was, be wary of debt. So again, I'm going to refer back to my medical student, because the banks were very excited to lend the medical students money. And the first thing I said to Georgie, my tenant, shall I call her, my lodger, I said to her, if you can't afford the car that you want to buy, you can't have it. So unless you can pay cash for the car, you can't have it. Anyway, she was quite shocked at that. But those are the kind of things that we need to be wary of debt when you talk about lifestyle assets. Then we'll talk about the investor, or your preservation assets. Just give me a second. So the preserver, or where you preserve your assets, we refer to you as the investor here. So the first question I often get from clients is, how much do I need? Now, I mean, there are a lot of people who have a lot of different calculations on how to do this. I have quite a simple calculation. I literally say, how much do you spend now on a monthly basis? And if it's, let's call it 40,000 Rand a month, if you divide that by 4, and then convert that number into millions. So if you divide it by 4, it gives you 10. And if you add that to millions, you say it's 10 million Rand. So if you're spending 40,000 Rand a month at age 65, you will need about 10 million Rand in savings. So it's quite a nice, easy calculation, and we can, I'm sure I can put it up later so that you can have a look at it. But really, the trick about savings is actually being consistent. Just give me a second as I move on. It's being consistent, and then Also, objectivity. So when we talk about objectivity, I mean that having somebody else that is looking at your investments. Otherwise, the biggest risk is that your emotions get involved in investing. And when we talk about your emotions, we're talking about fear, we're talking about greed, and we're talking about your history. Now, I've got a perfect example at the moment of what has happened to a client of mine. In the beginning of COVID, so COVID started, well, we went into lockdown end of March 2020. So at the time, but the market started dropping from about the 15th of March or beginning of March, the market started dropping properly. And when he got to the end of March, he got so scared, so fearful that he actually sold his entire equity portfolio. Now, the market at that point in time had dropped 40%. Do you know that he still has only invested 20% of the cash that he pulled out at that point in time? Now, I can see Yolanda's face, and we all know the market has recovered by 60%. So you have to know that that fear actually landed up him taking a real loss on his portfolio. But had he been to an objective person, an advisor, which he wasn't a client of mine at the time, we would have said to him, don't sell, just wait. The market will recover. But you see, because of the fear, he actually just pulled out market. And I have another client of mine that I'm also dealing with at the moment who also hasn't invested yet, because for the last 2 years, he's been sitting in dollar cash and he's too scared to enter the market because he just still doesn't know when is the right time. Again, the objectivity of somebody else helping him do that is what's important. Anyway, let's just talk about what other things we need to have a look at as an investor. We need to think global, so that what we would also call diversification. Yolanda will tell us a little bit more about that later. And then securing your cash flow. So make sure that your money is invested, but is still liquid. You know, markets move and markets change, and you need to be able to move when the market moves. And you don't ever want to be a forced seller when you need cash to live off. And then obviously, you know, the last one, which is no debt. You can't borrow money to invest money. Please don't borrow money to invest money. I have heard of people borrowing to invest. They're borrowing from their house to invest. I said, that's a very, very scary thing for me. Legacy. So once you have started building up this portfolio, you know what you need to accumulate. It's actually quite nice to have an idea of what that number is. So to go to a proper financial advisor, we actually advise our clients and say, we know that you need to have 5, 10, 15, 20 million. And then we'll build a plan on how to get there. And that is, it's quite nice to have a goal to get towards. As you're investing money, your legacy is important. So if something happens to you, how are you going to pass that on to the next generation? We'll also talk about your will. Please, I had a client, again, who had never changed his will for 30 years. In the 30 years, he had had 2 children from his first wife, got divorced, remarried, and had another further 2 children. And in his will, he said that he would leave his entire estate to his first wife. Quite scary. But it happens. I promise you it happens. So hopefully all of you have read your wills in the last 18 months. Now, investing for the long term. So obviously markets change, and we need to be always on the cusp of knowing where to invest to make sure that we get maximum returns. So Yolanda is part of our team, our investment team, which is based in Cape Town, and they they understand the markets intimately, and she is going to take us through what's going on in the current market environment and what to look out for at the moment. So over to you. Thanks, Yolanda.
Thank you very much, Gary. Good afternoon, everyone. Kerry, that was crucially important to just contextualize again the crucialness of having a proper financial plan. And I want to link that with economics and investments. And I guess the obvious question is, how do you link it? And the short answer is that if you don't have growing economies over time, the value of investments won't increase. Hence, we won't be able to grow our wealth or to sustain and improve our standard of living. And I guess also importantly, other people's standard of living, especially in South Africa and in Africa. And we won't be able to retire conveniently and leave some sort of special legacy. So having a financial plan and focusing on economics and investments crucially integrated. So those are the goals. But on this road, there are very specific pertinent risks. And the first one, I think you'll agree, is inflation. Inflation is problematic at the moment. I will show you a graph just now. I came across this very good example of how inflation can destroy you if you haven't planned for it. In the 70s, a Toyota Hi-Ace minibus taxi cost 5,000 Rand. I Googled it this morning. A Quantum costs 700,000 Rand. That's 50 years. If you look at the compound annual inflation rate over that period and you calculate it, it's just over 4%, over 10%. To give you a sense of, if you don't plan properly for inflation and invest a sufficient portion of your portfolio and your wealth in inflation-beating assets, it really can be problematic over the longer term. The second one is this 100-year issue that we are increasingly going to face. And it is interesting research by the Financial Times, which came to the fore and said, if you're born today, you've got a 1 in 3 chance of living to 100. And if you're 60 today, you're probably going to get to 90 years old. So I think the days of entering the job market or starting your own business and getting an income at the age of 20 and working for 40 years and then retiring on that wealth for 25 years, let's say to 85, I think those years are gone. I think we're increasingly going to enter people are going to enter the job market or earn an income at 20, work till they're about 70, and then make provision for 30 years. I think that's what we're in for here, because the risk is that we outlive our wealth. And it really is an increasing risk. I think the latest stats from the Actuarial Society internationally, the number of people who reach 100-year-old in the US is multiplying every year. It's doubling every year. So it is a reality which we need to work with. And then ultimately the necessary evil. We all have to pay taxes, although we don't want to. But it's a crucially important part of our plan. And our target, aim, and objective is to beat inflation after cost and taxes by a significant margin over time for our clients. So it's all incorporated into the solution. I think what makes Citadel unique is the fact that we have expert wealth advisors on the left-hand side, and we have expert asset managers on the right-hand side, and we interlink crucially. Every day we interlink with each other. We engage, we debate. There's absolute openness, but there's accountability from both sides at Citadel. And on the left-hand side, you have the teams of Karen and Kerry and other wealth advisors at Citadel, and they focus on the individual client, the family, or the trust, for example, and the financial goals and aspirations and the legacy. On the right-hand side, I'm part of the asset management team, and our responsibility is to focus crucially on the macroeconomic and investment landscape. Let me just give my pointer here. So the macroeconomic and investment landscapes, and I'm going to zoom in now on the economic complexities and trying to only focus on economic growth, inflation, and currencies. Those are the 3 crucial factors when you look at the economic landscape, and then aim to bring that into an investment view for you. And in an investment space, it is all about opportunities and risks. It's not only about opportunities. It's also very importantly about what to avoid, because these things are too risky or because they're overvalued, for example. And yeah, some of the examples of asset classes that we are investing in for our clients, both locally, domestically, and also in the rest of the world globally. I'll zoom in on those a little later. So for a quick economic outlook, if you look at the complete implosion, this is economic growth on a year-on-year basis of the major regions of the world. You look at this complete implosion during COVID, where economies, and if you look at the UK, that economy contracted by about 20% mid-COVID. Since then, we've seen a remarkably strong recovery. It's the rubber band effect. You stretch it hard enough, it bounces back quite strongly. Japan is growing at the moment at near 10% on an annual basis. The US near above 10, the Euro area as well. And then the UK was slow out of the blocks, but now growing at about 20% year on year. Compared to a year ago, the UK economy is now 20% larger in size. The red bars are the warning lights at the moment, and that's the G7 leading indicator. What that is the largest 7 countries in the world. Their leading economic indicator gives you a very good sense of what's going to happen in terms of economic growth over the next 6 to 12 months. And we can see how this indicator is absolutely forecasting a significant slowdown. We are living that slowdown as we speak. Economists globally are slowing down, and I'll zoom in on South Africa a little later as well. So a strong economic slowdown, but if you look at the level of the red bar, it is still above what we've seen on average over the past 10 years. So although economic growth is slowing down, it's still higher than what we've been used to internationally. I thought China was important because it's such an important player in the commodity space overall from a consumption perspective. China, as you may know, the only major economy that was able to grow in 2020, and the economy grew by 2.3%. They have bounced back remarkably. In the first quarter, their economic growth was also 18%, close to what the UK is growing at the moment, but you see the significant slowdown. In the second quarter to 8%, and then 4.5%, and they've got a significant number of crucial challenges at the moment there. First of which is their property sector with all the regulatory changes that came in there, and that's hampering the ability or normalizing it, I should actually say, the property sector in China, because it delivered an outsized contribution to economic growth, which was unhealthy. They've got significant power shortages, and then COVID is phenomenal. I read the stats this morning. They have 118 total new COVID cases compared to yesterday. 119. Their approach to COVID is so draconian that they've cancelled 22,000 flights that were scheduled for the next 3 months because of that COVID outbreak. And it is now the largest COVID outbreak in 9 provinces since the start of it in Wuhan. So they really take drastic measures, and it will hurt the economy. For now, for 2021, we do expect China to still grow on a year-on-year basis compared to 2020 and 2021 by about 7 to 8% because of the significant rebound in the first half of the year. But they're slowing down fast, and unless they stimulate soon, we do expect China to be in a hard landing. And for me, that is anything for China of growth on a year-on-year basis of below 5%. See, yesterday, the Premier acknowledged that there's significant slowdown underway. So I do expect the authorities to do some stimulation and add some stimulus to the economy in the next while. If we do a synopsis of the global view, we can focus here on the global economic growth anticipated for the next 12 months. And then after that, so that's not 2021 and 2022, it's the next 12 months and 12 months after that. 4.7 and 3.6. How do we contextualize that? If you look at potential growth in the global economy, you take population growth and productivity growth, and a rough measure is add the two together. That brings you to potential growth for the global economy, and that's roughly 2.5 to 2.7% at the moment, potential growth. So if we foresee 4.5 and 3.5% growth in the next 24 months, it is at least 1 to 2 percentage points higher than potential growth. So it's a very good global economic scenario and backdrop that we're sitting with at the moment, although we have seen peak growth already globally, and we are in the middle of a slowdown. I'll touch on inflation just now. For now, we expect global inflation to not be out of control and to not spiral into a 1970 inflation where we're seeing global inflation of 5, 6, 7, and 10%. Crucially important, that point. So yes, there is a significant inflation at the moment. I think here in South Africa, we felt it yesterday again with the petrol price increasing by more than R1, and we now pay nearly 20 Rand a litre for petrol. We are seeing a fairly slow increase in inflation in South Africa. It's still well contained. Elsewhere in the world, it's not. In the US here, this dark ochre line, the US inflation is currently above 5%. They are aiming for inflation of 2.5%, so it's double what they aim for. The euro area always struggled those countries with low inflation, they're currently sitting at about 3%. The UK's target is 3%, so they're fine in terms of their target. China's inflation rate is completely connected with the pork price. That has shot the lights out last year, and it's coming down at the moment, which is pulling Chinese inflation down. And then Japan has struggled with deflation, as you know, or negative prices, falling prices, for a long time. So yes, we have a rising inflation problem because typically what you see when inflation is rising is that demand outstrips supply, or the growth in demand outstrips the growth in supply. Currently, we have both those issues because we have very strongly recovering demand post-COVID. There's still loads of people who have loads of cash, especially in America and elsewhere, from the handouts in COVID time, which they haven't spent. So you have strongly recovering demand, and then you have supply bottlenecks and labor shortages. You saw over the weekend how American Airlines canceled thousands of flights because of labor shortages. And then energy costs, we all know that the oil price is about 80 at the moment, which is hurting all of us. So yes, we do have an inflation problem internationally, but crucially important, it has turned. So that's the year-on-year. The ochre line is still the year-on-year inflation, the normal rate that we got generally in South Africa, that's currently 5%. Globally, that rate on the left-hand scale here is about 4%. And if you look at the shorter-term momentum to give you an indication of where that longer-term number is going to head to, it reached nearly 6%, but this is now down to 4%. So our view here is that inflation has peaked globally and that we're unlikely to see the spike towards 10%. Crucially important assumption. The question in many people's mind is, are we going to see a recession as a result of this high inflation and central banks hiking interest rates in order to kill inflation, but then they also subsequently kill the economies? Are we going to see a recession as a result of that? Our view is no. We are not likely to see a global recession now, and crucially important, these words, unless we see a policy mistake. And I'll get back to that just now. So we follow and closely monitor about 10 different macroeconomic and market indicators, which are listed here. And if you're interested, please do contact me. I'll take you through each of them. It's just too little time today to go through each of them. I'll give you the synopsis. And if an indicator here is green, it tells you that the current level of this indicator is not a cause for concern from a recession perspective. And if the specific indicator here is yellow, orangey, it tells you be concerned and follow this closely, monitor it closely from a recession signal perspective. And currently, as you can see, the majority of these are still green. And our take is that currently we see a less than 25% probability that we'll see a recession in the next 12 months. But there is a risk that policy mistakes could come into the mix. What do I mean with that? Primarily currently in this economic cycle, the biggest policy mistakes that could be made by central banks would be if they hike interest rates too much because they fear inflation. They fear that inflation is going to spike out of control, and hence they react very fast and they hike interest rates a lot in order to kill inflation, but then they push the economy into a recession. We are seeing risks of that in a variety of emerging countries at the moment, but in the developed world, the central bank has said that we are patient, we're going to wait for this. We have been running under targeted inflation for a number of years, and hence why we're willing to accept higher than average inflation for the foreseeable future. So the risk is small at this stage, and we don't foresee a recession unless there's policy mistakes. In China, the policy mistake is the complete opposite in that they don't act fast enough. They don't have an inflation problem. They can stimulate the economy from growth and monetary perspective via interest rates and from a fiscal perspective via government spending, and we're waiting for that to happen. From an economic growth perspective in South Africa, similar to what we've seen internationally, South African economy shrank by 15 to 20% during COVID, bounced back beautifully. So similar growth to the UK, year-on-year growth, 20% at the moment. But again, our leading economic indicator, this ochre line, is telling us, don't be super excited. Things are cooling down very fast towards a normal rate for South Africa. So we're following the international trend, that's what we normally do. If you look at two main indicators in South Africa, the one is business confidence, the black line here. You can see how that started to implode during the riots that we've seen earlier this year in KZN and Gauteng, horrific riots, social unrest. That caused business confidence to decline. And then in the manufacturing sector, the ochre line, if this line's value, which we read on the left-hand side here, if this value is above 50, it gives you an indication that the manufacturing sector in South Africa is still growing, it's expanding. Don't know what your experience is if you are in manufacturing. Currently, the latest number was released yesterday, 50, call it 54. So it's cooling down from nearly 60 to 54. It is still above the 50 line, so manufacturing is still growing, but it has been hampered in the most recent month and weeks by the strikes that we've seen, and then Eskom with hitting us again with significant load shedding. Our export is a significant driver of our economic growth over time. That is beautifully expanded post-COVID as we provided a lot of commodities into the global economy, especially to China. And now we're seeing that also normalizing to a more sustainable rate. So a significant slowdown in South Africa economic growth-wise, similar to what we see in the globe. Same table as the previous one I showed. Here we have South Africa included. The next 12 months growth expected in South Africa of about 3% and then going down to about 2%. Our population growth in South Africa is around 1.5 to 1.6%. We do need economic growth of higher than population growth if we want to solve the issues in South Africa. We do need to maintain growth of higher than 2.5% if we really want to make a dent in poverty in South Africa and unemployment. And inflation in South Africa also expected not to be out of control. Crucially important slide, this one. It's technical, it's busy. I'll try to explain the best I can. This is Citadel's view on the rand-dollar exchange rate, a crucial component when doing financial planning. Karen and Kerry will tell you all about that. If you invest too much money offshore and you don't manage the currency beautifully and you retire on that money and the rand strengthens significantly versus the dollar, for example, it's a tough situation for your financial affairs. Opposite is also true if you invest offshore when the rand is relatively strong or at fair value, and the rand depreciates or weakens over time, then you get the benefit of that in your wealth. So what we have here, the red line is the actual rand-dollar exchange rate on a logarithmic scale. So please do ignore these numbers and rather focus on the trend because it's a log scale. The green line is our model forecasted rand-dollar exchange rate. And that is where we take these economic variables, leading economic indicator globally, commodity prices, the current account deficit and inflation differentials, all fairly technical. We add those variables into an econometric forecasting model. And given the level of these indicators, it tells you what the level of the rand should be relative to the dollar. We then subtract the one from the other, and that gives you this blue line residual. So what we see is if the red line, which is the actual rand-dollar exchange rate, is above the green, the modeled or forecasted based on these economic variables, if the red line is above the green line, it tells you the rand is too weak relative to its economic fundamentals. You see that happening there. You see a significant happening there. It's too weak, and you see the rand being too weak there. The opposite is also true. When you see a period here where the green line is above the red line, that tells you the rand is too strong. We had another situation here where the rand was too strong. And you can see over a period of, what do we have here? 40 years, we have 1, 2, 3, 4, 5 opportunities in 40 years when the rand has gone significantly stronger than its suggested fair value. These were phenomenal points to take money offshore. There's only 5 of them over 40 years. So you can't only wait for phenomenal opportunities. You have to make use of smaller opportunities. So where are we at the moment? You can see the last data point there is very close on the 0 line. That means that the rand, last time I looked just now, was 15.35 to the dollar. At that level, the rand is roughly equal to its fair value. The thing about the rand being at fair value, it never stays there. You can see it touches the 0 line and then it goes either higher or lower. And in our view, given the current circumstances, what's happening in South Africa, the challenges, the fiscal challenges, for example, we do think that now is an opportunity to take money offshore, more money offshore. Obviously, not as great an opportunity as these 5 points that we've seen in the past 40 years, but a decent opportunity to take more money offshore. So in summary, from an economic perspective, we've seen the peak growth internationally. We're not going to see those 10, 20% year-on-year growth numbers again. It's growth moderation, but it's still above the long-term trend and potential growth of the world economy. We do think there was a recession risk pre-COVID that is now lower because of the economy is adjusting. And there's significant stimulus from central banks and governments still in the system, but crucially important central bank action is vastly important going forward. They could make a mistake and that could cause a recession, although that's not our central case at the moment. We do think that this new growth cycle that we are in with above normal growth for the world economy should be positive for companies in particular to make good profits. In other words, that in investments in equity markets and shares is not necessarily a bad idea at the moment, despite this recovery that Kerry has mentioned post-COVID. There's still a good opportunity there. I'll delve into that just now. Inflation, we don't think will spiral out of hand. South Africa, we do think still have those structural issues. We'll lag our emerging market peers. There are still some reform steps that's been positive and that's starting to pay off. But with the local government elections of Monday, we're going to go for coalition government metros. And I think that will be a challenge for South Africa to implement policy in a very efficient way. So South Africa probably lagging its emerging market peers going forward until we have structurally sorted out the majority of our issues. That's the economic view. Now, how do we translate an economic view into an investment view? And crucially important for us is our investment philosophy. I see the video that you played also earlier talks about investment philosophy and the pillars of an investment philosophy as crucially important. The last thing you want to do in an investment team when there's a crisis in financial markets or in the economy, you do not want to have conflict about your philosophy. You do not in your team, when there's stress, want to have conflict about should we buy or should we sell. Our team strongly of the conviction that when something is overvalued, we do not want to invest in it or invest more money in it. And when something is not overvalued, you would see us buy. So we are not momentum players. We don't buy as the price increases. In fact, we want to trim as the price increases. But for us, there's crucial difference between price and value. And I thought of an example here. I think very typically people can confuse the two. Price does not equal value. Let's say you've got a dining room table in your lounge that's cerise pink, and it's made from pressed wood. That costs 2,000 Rand, and you paid 500 Rand to have it painted cerise pink. For you to replace that, it would cost you 2,500 Rand. However, because of some sort of a craze in home decor, people want cerise pink lounges or cerise pink dining room sets. And they're willing to pay you 10,000 Rand for that. That for us is a classic situation of where the price is too high relative to the value, the replacement value. And we would tend to not buy into opportunities like that, but rather sell. We call it feeding the ducks. We like to feed the ducks. If they want to buy from us at expensive prices, we likely to sell to other buyers at those levels. Asset allocation, crucially important. Over time, it's less important if you decide to buy a share of Absa versus First Rand versus Standard Bank, for example, in the banking sector. It's far more important in your portfolio. The mix that you have between cash and property, listed property, for example, shares, managed volatility equity, international shares, all of those local versus SA and how you manage your currency. Crucially important, far more important than the underlying stocks is the asset allocation. And then we absolutely firmly believe in reducing risk by combining assets. And yes, that is that not all eggs in one basket concept. We strongly believe in that. And then the future is uncertain and will often surprise. It has surprised us again with COVID out of the blue. And we absolutely do stress test client portfolios for various economic scenarios. So these are the 4 pillars on which our investment philosophy stands and falls. We bring those economic views of earlier into an investment view. And this is a crucial slide for us, the next 2 slides, and then I'll end with summary. This is the expected return per unit of risk. Now, it's a bit of a technical concept, but this is our expected return assumptions based on our economic input for the next 3 years and how we view different asset classes relative to the risk. So to give you an example, on a low risk asset class like cash, if you look at volatility risk, it's the long-term standard deviation. It means the level by which the price movement of an asset class moves up and down. Is it very volatile or not? On the left-hand side, the closer to zero, the less volatile an asset class is, as you can see here. You invest 100,000 in the bank, you do not expect that 100,000 to be worth 50,000 at the end of next month. It's a very gradual investment where you will benefit over time gradually, and if you're lucky, you'll beat inflation with cash. On the other side of the spectrum, you have something like SA property, which is vastly volatile. If you've been invested in South African listed property on the shares on the JSE, you have up to the end of October achieved 66% return over the past 12 months, but you are still down 20% compared to 3 years ago. A very volatile asset, but it will reward you over time handsomely for the risk that you take. So typically in this space, the higher the risk that you take in an asset class over time, not every quarter, not every month, not every year, but over 3, 5, and 10-year cycles, the higher risk you take in financial markets, the higher your reward is typically. And this is currently the case as well. From an expected return perspective, if we look at the higher risk assets here, which are all equity market shares listed on stock exchanges, these currently have the highest expected returns. And by far, the best one of those is South African equity, because those company profitability has come through significantly and the valuation, the expensiveness of SA equities has come down significantly as a result of the increase in company profitabilities. So in the equity space, we see a lot of opportunity over the next 3 to 5 years. And then in the fixed income space, bonds, government bonds, for example, in the US, they're yielding 1.5% as of yesterday. Inflation is at 5%. We're not going to invest in US bonds in our client portfolios unless we really have to in the very, very low and conservative portfolios for clients and where they demand it, perhaps from an objective matching perspective. So this is where we see the value. This is another flip side of the coin of the same analysis that we do, but the essence of understanding the stable lies in this section here, where we're going to focus on this ochre section in the middle, which is the neutral outlook. So we have the specific asset classes on the left. There's about 16 of them. And then we look at the neutral outlook, and that is what investors in this specific asset class could have expected from this asset class over the past 100 years. So it's not biased, it's not a cyclical view, it's a long-term view of what you can typically get from an asset class after inflation. Over time, you get about 1% above inflation for cash, about 3% above inflation for government bonds, 5% for listed property, and by far the best compared to cash is equity or stocks. And then we look at where the dot is next to a specific asset class. So let's look at SA equity. We looked on the previous slide and it said that the expected return for SA equity is quite high. And here we see it as well. The dot is above and 2 notches above neutral, which tells you compared to its own history, SA equities is really not expensively priced. And given current valuations, you are likely to receive more than inflation plus 6% per annum over the next 3 to 5 years. I noted the other 2 equity categories, emerging market and global equities, they're 1 notch above neutral. So you're likely to expect going forward from emerging market equities and global equities about 5 to 6 to 7% above inflation over the next 3 to 5 years. I noted the fixed income space, US government bonds, for example, not attractive at this stage. You're not going to beat inflation. The other outlier and a good opportunity is South African bonds. There's risks to this because our financial situation is fairly precarious, but the yield is rewarding you for that risk at the moment. At 10% yield and inflation is at 5%. It's not a bad opportunity at the moment. So to do an overall synopsis, we do expect global growth to still be above potential for the next 24 months. And that should support company profitability. The companies listed on the stock exchanges or in secondary markets like the company that we are, the AWIB company. Please do note that there is the risk of policy mistakes by central banks. From current valuation levels, the expected return for risk assets in particular, and then equities, South Africa, emerging and global, is above normal, but it will come with volatility. But volatility is your friend if you understand the valuation. So if you see there is a good opportunity in equity and the market sells down by 2 or 5%, then you allocate more money. And if there's another down day in the markets, then you allocate more money to it, because your fundamental view based on the analysis is that there's value in these equity markets. And hence why if prices fall, you don't run for the yields. In fact, you stand closer because there's good quality assets selling at discounted prices, and you buy into that for the longer term. I mentioned South African government bonds, not without risk, but a good real opportunity at 10% yields on the R2013 relative to 5% inflation. Global fixed income is a no-no for us at the moment. You're not making money there after inflation. And then crucially important, from a currency risk perspective, always absolutely fundamental to the financial plan, and it's something that we actively manage. And I hope that I was able to show you that at current values of around 15.35 to the dollar, the rand is fairly valued. It is not the opportunity for a lifetime to take money offshore, but it surely is a good opportunity, given our view of where the rand is heading over the medium to longer term. And that was the last slide from me.
Thank you. I know you had a lot to share, and that was really so beautifully presented. So to both of you, thank you for your time and for sharing those that you're thinking with us. I think there's lots of food for thought. Ladies, there haven't been many questions coming through on the chat box. I know we are on 3 o'clock. There was just one question that I wanted to raise, and Kerry has responded, but it is a great question. And Christine asked, is there anything wrong with taking debt on property if it's an investment property? Sorry, she asked, is it wrong to borrow money to invest in property or assets that can generate revenue or income? So Kerry, maybe just a quick touch on that, because I know you're also passionate about property, as most of us are, and maybe just to explain that, because I think it's just such a great question.
Yes, it is a great question. Thanks, Christine. Remember, it depends on which block it falls into. So does it fall into that lifestyle block, or does it fall into that investment block? If we're talking about property for an investment purpose, I'm absolutely happy with debt on that. When we're talking about property for your primary residence and for a holiday home, you need to try and pay off that very quickly. So I know, and I completely understand that your first property that you buy to live in is very hard to be debt-free on day one. I mean, who has... Sorry, something just dropped in my office. It's very hard to be debt-free on day one. But actually, so try and pay your primary residence off as quickly as possible. And then, but for an investment property, I'm very happy with that.
Thanks, Kerry. I don't see any other chats coming through or questions coming through, but what we are going to do is share the recording with all of you in the next day or so, and we'll leave our contact details. So should there be anything that you still want to raise? Okay, one's come through. I'm just going to read it out. How does one build wealth for a business to be sustainable with the aim to build wealth?
So thanks, Karen. I'll take that one. When you're talking about building wealth for a business, so the one thing about being an entrepreneur, and entrepreneurs are notoriously bad about it, is not taking money off the table. So when your business starts making money, you actually have to start diversifying and taking a little bit off the table every month, every year, to be able to start building up that separate pot. I can promise you that before COVID, I know many a function venue or restaurant that was doing so well that they thought it would go on forever. And then COVID hit. Nobody suspected COVID. And actually, but had they had enough savings, that their wealth would have been secured. So the trick about building wealth and building up a business is actually to keep taking some wealth off the table consistently. So consistency is key, and then long-term investments. So it's time in the market, it's not timing the market. You've got to do it for a long time, and just a little bit of discipline, and we'll all be there, financially independent. Does that answer your question, Bonnie?
Kerry, thank you. I suppose it's that classic, you know, having something for a rainy day.
Absolutely, yes.
I think I'm going to close off. It is just 4 minutes past 3 o'clock. I just wanted to say the biggest thank you to all of you again. As Kerry said, it's, you know, it's really hard, these Zoom events, because there's no engagement, as we are so good as women to connect and just feel each other's energy. So I really hope we're going to continue to build our relationship with African women in business, and hopefully at some point soon we'll be able to have a glass of wine, Shiphra, in the same room with your ladies. I know they are spread across Africa, but who knows when our paths will cross. I'm just going to close off and say have a wonderful rest of your afternoon, and I'm going to hand back to Shiphra. Thank you so much.
Thank you so much, Karen, and thank you, everyone. Thank you for time spent with us. And I like what Kerry just closed off with now, saying it's time in the market, not timing the market. Kerry, that is just quite a pair of wisdom for me. And we just had the IMF releasing the regional stats on economic outlook and also the trajectory. So Yolanda, thank you so much for giving us those that info. And I think with the video, if probably we can have for our members the presentations as well. But what I wanted to close off by saying is that we have asking Citadel to contact each and everybody who's on the call, as you've heard today that we cannot really do this on our own. We need help, ladies. So we've requested the team to have calls, one-on-one calls with you, so that they can be able to assist you to put this together. They can be able to assist you to put a portfolio together, and also be able to assist you and to direct you which way to go. So thank you very much to the team. And we had a very interesting and very engaging conversation. Thank you, ladies, very much. And have a wonderful afternoon, everyone. We look forward to talk to you further. Thank you.